Same 10 stocks, same returns on every single one, different outcomes. Um, Investor A allocated 5% to every position, regardless of conviction, regardless of how asymmetric the risk reward was, regardless of how um, thoroughly the thesis had been tested. Clean, simple, consistent. Investor B allocated 2% of developing stocks, where the thesis was early and uncertain, 6% or more on higher stocks, on higher conviction stocks, where analytical work was complete and upside materially outweighed the downside. Same stocks, same market, same year, same returns on every individual position. The portfolio outcomes were materially different. Most investors spend almost all their analytical energy on which stock to buy, which company to research, which turnaround to back, which setup to enter. The sizing decision, how much capital to put behind each of those conclusions, get tested and get tested as an afterthought. The rough percentage or the rough percentage decided in the moment of the entry, often influenced by how excited the investor feels about the opportunity rather than the asymmetric assessment of conviction and risk reward. That afterthought of cost that afterthought is costing more portfolio returns than investors realize. In this video, I want to show you the complete framework I use for every position, swing trade and turnaround investments. Before I commit any single dollar, where the numbers came from, that what the two variables are that determine where where in the range I land, and the framework allows me to go above the standard ceiling and the three sizing mistakes that framework is specifically designed to prevent. Let's start with the base range. Hmm. The base range for every position in my portfolio is 2 to 6% of the total capital. Not 1%, not 10%, 2 to 6%. And I want to explain precisely where those numbers come from because they are not arbitrary. Each boundary exists for a specific reason that is grounded in my portfolio mathematics rather than my personal preference. Floor 1. Why nothing goes below 2%? Why nothing goes below 2%? A position below 2% of the total capital cannot move the portfolio meaningfully, if the thesis, even if the thesis is completely correct. Let me show you the arithmetic. If you put 1% of the total capital um, into a position that returns 1,000%, a genuinely exceptional outcome, the portfolio impact is 10%, and that 10%, and that and that 10% impact, in how much time it will come? It will probably come in like 10 years, or like if you're lucky, maybe 5, if you're lucky. So usually it comes in 10 years because my portfolio on average produces 26% returns. So it comes in 10 years. And in that 10 years, my portfolio would have 10x too, at least like around 10x or 8x, 10x. So the total return from this 1% of the capital invested would still be 1%, even after the stock doing really well. The 2% floor exists to force a discipline question before entry. If I'm not confident enough in the thesis to allocate at least 2%, I should I should ask whether I am confident enough to own it at all. Sometimes the answer is no, and the position should not be entered until the analytical work advanced has advanced enough to justify the minimum allocation. Sometimes the answer is yes, and the 2% floor creates a honest minimum honest minimum that reflects genuine, if early stage, um, if early stage conviction. Now the ceiling, 6%. Why 6% goes above? Why nothing goes above 6% in a standard framework? In a standard framework, a position above 6% of the total capital begins to create individual stock risk that cannot be adequately offset by the rest of the portfolio. Here's the mechanism. At 6% sizing, the complete loss of the position costs this portfolio 6%. A painful but recoverable within the range of what a sound portfolio can absorb without permanent capital impairment. A 10% sizing, a complete loss cost the portfolio 10%. At 15%, though at those levels, a single thesis error does not just hurt the portfolio; it impairs the portfolio's ability to compound for years. And turnaround investing, especially where the thesis can be correct if in diagnosis, but wrong in timing, where a position can be underwater for 12 or to 18 months before the recovery becomes visible, requires a sizing discipline that allows you to be patient through extended drawdowns, without a psychological and financial pressure of an oversized position forcing a premature exit. Um, the 6% ceiling is a mechanism through which I ensure no single thesis error can permanently damage the portfolio, because not because I expect it to be wrong, but because a sound portfolio construction acknowledges that I will be wrong in some percent at some percent of the time, and the ceiling ensures that the cost of being wrong is always recoverable. The two strategies within the range, um, the swing trade six sits between 3 to 5%, not 2 to 6%. 3 to 5% is a narrow range. It reflects the more defined nature of swing trade risk reward. I enter a swing trade because of a specific technical and fundamental setup is present. The setup either resolves um, the expected direction within the expected time frame, or doesn't. The binary nature of the that resolution, compared to a multi-year thesis development of a turnaround, means the sizing should be tighter and more consistent across positions. I do not need the full conviction based range for swing trades, because the entry conditions and are more standardized. Turnaround positions use the full 2 to 6% range because turnaround theses are more differentiated from one another. A governance collapse thesis, an industry downturn thesis, a competitive squeeze thesis all carry different conviction profiles and different asymmetry characteristics. Um, the sizing should reflect those differences rather than flatten them into a consistent allocation. One more important clarification: 2 to 6% range applies to initial position sizing. It does not prevent me from building up position over time as the thesis develops and conviction increases. A position that enters at 3% standard conviction early Stage evidence can grow towards 5 to 6% as the thesis is confirmed through consecutive quarters of delivery as asymmetry improves with a lower price or as the checklist moves from amber to green on monitoring metrics. Um, that staged that staged buildings entering at minimum justified size and adding as evidence accumulates it is accumulates is actually the most disciplined application of this framework. It prevents me from overcommitting before the thesis is established and reward the position where the analytical work is confirmed by real world evidence over time. The base range is 2 to 6% is uh, the base range 2 to 6% is the container. The two variables I'm about to show you are what determined whether whether within that container any specific position lands. Two variables determine whether where within the 2 to 6% range map any position lands. Conviction and asymmetry, not one, both. And the relationship between them is not additive. It is multiplicative, which means high conviction on an asymmetric bet does not justify large position. A, a high asymmetry on a low conviction thesis does not justify a large position either. Both must be present simultaneously for a position to earn a upper end of the range. Let me define each one precisely, because these words get used loosely in investing content, and the loose definition produces loose sizing decisions. Conviction. Conviction conviction. Conviction is how thoroughly you applied the analytical framework to a specific thesis, and how cleanly the framework produced a positive conclusion. I want to be precise about what conviction is not. It is not excitement about a story. It is not optimism about a sector. It is not confidence that a stock will go up. A story can be exciting and the thesis can be weak. Optimism can be high and the analysis can be superficial. Those are not conviction, they are enthusiasm. And enthusiasm does not justify a position sizing, a sized position. Conviction in my framework is earned through one specific process, running the 7 question checklist completely, with specific evidence for each answer, and arriving at results where the gatekeepers pass cleanly and collaborators are predominantly green. Low conviction is one or more gatekeeper questions are amber. Um, Execution evidence is absent or mixed. Management quality assessment is uncertain. A developing thesis where the analytical work is incomplete or the evidence is early stage. This positions the allocation towards the 2 to 3% zone, regardless of how attractive the story sounds. Standard conviction, all gatekeeper pass, calibrators are predominantly green, one or two amber on execution evidence or market optimism. The thesis is established, the evidence is accumulating, the framework assessment is positive. The position, this position, the allocation in this position, the allocation is in the 3 to 5% zone. High conviction, all 7 questions passed cleanly. Execution evidence is confirmed across multiple quarters. Break break thesis break condition are remote and specific. This is where the analytical state and that position towards this is where the analytical state that position towards the upper side of the range. And I want to be honest, genuinely high conviction of these qualia is rare. Most positions live in the standard conviction for most of their holding period. High conviction is earned through sustained thesis confirmation over time, not assumed by entry. Asymmetry. Asymmetry is the relationship between the potential upside and the potential downside at the current entry point. A position where a central recovery scenario implies 150% upside and thesis break scenario implies 25 to 30% downside is asymmetric. The potential gain materially outweighs the potential loss. That asymmetry justifies a larger allocation because expected value calculation favors the position, even accounting for the possibility that the thesis does not play out perfectly. A position where the upside is 40% and the downside is 35% is not meaningfully asymmetric of how regardless of how high the conviction is. Risk to reward does not um, risk to reward does not reward a large capital allocation, even when the thesis is sound, because the penalty for being wrong is almost as large as the reward. So, for being right, I assess asymmetry through two inputs: the valuation work and the technical setup. The valuation work gives me the fundamental asymmetry for four methodologies: a scenario analysis, an implied market cap range, the distance between the current market cap and the midpoint of the range, the relative to the distance between the current market cap and the thesis break downside. The ratio is a fundamental asymmetric number. The technical setup gives me the timing asymmetry. A stock is technically base building. A stock that is technically base building accumulates with declining volume on down days and increasing volume on up days, with clean pattern forming above key support, has timing asymmetry. That then a stock that is technically still active in active distribution. The technical setup does not change the fundamental asymmetry, but it influences when within the fundamental asymmetry window, the entry is almost efficient. Is the most efficient. The four quadrants, uh, what one, what each one means for sizing. High conviction, high asymmetry, both variables present simultaneously. The thesis has been thoroughly retested, the framework has passed cleanly, and the upside materially outweighs the downside. The technical setup confirms the timing. This is where the maximum position sizing is justified. 5 to 6% of the total capital. Low conviction, low asymmetry. Um, low conviction and low asymmetry. The thesis is underdeveloped. The risk to reward is not compelling. Either the analytical work is incomplete, in which case the position should not be entered until it is, or the work is complete and the conclusion is that neither variable is sufficiently present to justify the capital. This is the zone where honest assessment says, wait. High conviction, low asymmetry. You believe in the thesis, but the entry point does not offer compiling risk reward. The stock has already moved towards fair value. The upside from there is moderate. The correct response is to avoid the position. It is it is to size at a mid 3 to 4% and wait for either a better price entry to improve asymmetry or continued thesis confirmation to strengthen conviction case for larger allocation. Low conviction, high asymmetry. The valuation is compelling, the stock is cheap, and the upside is significant relative to the downside. But the analytical work has not yet produced high conviction. This is the most dangerous quadrant to oversize. The temptation is to let the attractive valuation compensate for incomplete analysis. It does not. It does not. Cheap stocks stay cheap for reasons that incomplete analysis has not identified. Mid-range sizing with tight monitoring and commitment to either complete the analysis or to earn higher conviction, or exit if monitoring reveals why the stock is cheap, is the correct response. Um, but it is not a good idea to enter a position when your analysis is incomplete. It is never a good idea to do that. Let me show you the two. Let me show you two of my current positions and where they sit on the grid, without revealing exact sizes but showing relative positioning that shape the allocation decision. Yes Bank is placed in high high con, mid conviction and high asymmetry. The governance thesis is thoroughly diagnosed. 7-question checklist passed with one amber execution evidence that has since improved, and um, the valuation gap between the sorry, it is mid conviction and mid asymmetry, and the valuation gap between the current price and the recovery scenarios is normal. The SMBC entry at 21 rupees provide an institution anchor for asymmetry assessment. This position sits towards the upper end of the side range. Indigo paints is high conviction and high asymmetry. It is higher than Yes Bank. The thesis is sound. The checklist passed with one amber on execution evidence that remains amber. The recovery is real, but earlier stage, early, but it's on earlier stage than Yes Bank. The asymmetry is compelling. The highest ever quarterly results on the lowest ever 5-year price. But the conviction is at the highest it can be. Again, I'm saying that I'm super bullish on Indigo Paints. Probably more bullish than any other stock that I have. The position sits at um, the higher to a standard of the range, and will be sized up as will be not will be sized up will be maintained as the execution evidence continues to accumulate. Two positions, both in my portfolio, different quadrant placement. Um, Different sizing implications. The grid is not ranking of which position I prefer. It is an assessment of where each one currently sits on the two variables that determine appropriate allocation. Now, both of those positions sit within the standard framework, but there are situations, rare ones, where the framework standard ceiling understates the rational allocation. That is the conviction override, and I want to address it carefully because it is the most powerful and the most dangerous tool in position sizing. The standard framework 2 to 6% conviction and asymmetry determining where within the range. um, handles the vast majority of the positions correctly, but occasionally, rarely, a situation arises where the ceiling understates the rational allocation, where the conviction is so thoroughly established and the asymmetry so clear, confirmed that staying within the 6% it is itself a undisciplined decision where analytical where the analytical work has produced a conclusion so complete that size below what the evidence supports is a form of intellectual dishonesty about the framework actually found about what the framework actually found. That situation is what extraordinary conviction override addresses. Notice where it sits on the green. It's not a separate zone. It's not a different framework. It's the furthest corner of the maximum size of the quadrant. The situation where both variables are not just present but confirmed at the highest possible level simultaneously. Let me define precisely what extraordinary extraordinary conviction over requires, because this is the tool most vulnerable to misuse, and the condition for applying it is deliberately demanding. Condition 1: all seven checklist question pass with no ambers. Not six of seven, not five with two ambers. That is that I've talked myself into accepting. All seven clean green for every question. The three gatekeepers without qualification. The four calibrators confirmed with the specific evidence across multiple data points. If any question is amber, the override does not apply. Amber Amber means uncertainty remains, and the position above the standard ceiling should have no meaningful remaining uncertainty about the fundamental thesis. Um, Condition 2: asymmetry of at least 3 to 1 on central scenario. Not a not a compelling valuation, not meaningful upside, a specific calculated ratio where central recovery scenario implies that at least three times the return of the thesis break downside scenario. This condition prevents the override from being triggered by optimistic valuation without genuine downside discipline. 3 to 1 ratio forms an honest assessment of both sides of the scenario simultaneously, not just the upside. Condition 3: thesis break conditions that require multiple simultaneous failures. A thesis break condition that can be triggered by one metric reversal, one bad quarter, um, one bad quarter of volume growth, one margin compression event does not qualify for the override. The override requires a thesis where the break conditions are structurally robust, where the thesis remains intact unless multiple independent variables deteriorate simultaneously. This condition distinguishes between a thesis that is deeply established and a thesis that is merely attractive. A, a deeply established thesis survives individual adverse data points because the supporting evidence is broad and layered. An attractive thesis collapses on a single adverse quarter because it was never broad enough to observe individual failures. Condition 4: the position has been monitored for at least one quarter with the thesis intact. No override on new entry. No override on a position entered last month. The extraordinary conviction override requires demonstrated patience. The thesis has been established, the monitoring has been active, and the framework has been applied to at least one full quarter of new evidence, with the conclusion remaining consistent. This condition is the most important protection against the most common misuse of the override. Applying it to applying it at the moment of maximum excitement about a new position, before the evidence has been tested against reality. Now I want to be direct about something that most position sizing frameworks avoid saying. Extraordinary conviction override is the most dangerous tool in the framework, not because the conditions are wrong. They are deliberately rigorous precisely because the tool is powerful, but because the conviction is the most subjective of all variables, and the human capacity of self deception is assessing conviction is in assessing conviction is genuinely significant. I have been in situations where I believed all four conditions have met, in retrospect, the conviction was partially earned through analytical work and partially earned through emotional attachment. That comes from spending significant time researching a position. Those two sources of conviction feel identical at the moment. They produce different outcomes. The four conditions specifically the filter out emotion to the four conditions exist specifically to filter out emotions and emotionally sourced conviction from analytically sourced conviction. They are not obstacles uh, to sizing up. They are verification, and that they are the verification that the conviction is real. Um, When all four conditions are generally met, not believed to be met, generally met, the override allows sizing above 6%. How far above 6% depends on how far into the top right corner the position sits on both variables. I do not apply a new fixed ceiling at 10 to 12%. The override is qualitatively judgment override is a qualitative judgment. That is, the standard ceiling understates the evidence, and the positions is sized to reflect the judgment within the bounds of the portfolio, what the portfolio can observe without creating a single stock risk that threatens the overall compounding. The honest practical truth about this tool I've applied is rarely. I have applied it rarely. Genuinely rare situations where all four conditions meet simultaneously. That rarity is not failure of the framework. It is the framework working correctly. If the extraordinary conviction override is being applied regularly, it means the conditions have been relaxed to accommodate enthusiasm rather than applied rigorously to reward evidence. The rare application is the sign of a healthy override. Frequent application is a sign of a rationalized one. Before I close, three before I close, three mistakes that this framework is especially designed to prevent. I'm covering these not because they're theoretical errors, not because but because very I made versions of all three, and I want to be precise about what each one looks like in practice. Because the most dangerous mistakes are the ones that you keep that feel like disciplined decisions in the moment. Mistake number one: um, sizing based on recent performance. What it looks like. Adding positions because it has gone up, reducing because it has gone down without any corresponding change in the thesis or in the conviction and asymmetry assessment. This is the outcome of dependent. uh, this is the outcome dependent investor making a sizing decision. The position has risen. It feels validated. The conviction feels higher. The temptation to add is strong, but the price is going up. The but the price going up hasn't changed the thesis. It has changed the asymmetry, usually for the worse, because the upside has reduced as the price has approached fair value. Adding at a higher price with a lower asymmetry because of recent performance feels confirming, um, but it is the exact opposite of what the framework prescribes. The correct sizing trigger is the change in conviction or asymmetry, not a change in price. If the conviction has increased because new evidence confirmed the thesis across another quarter of delivery, um, that is the kind of reason to add. If the asymmetry has improved because the price has fallen while the thesis remains intact, that is a good reason to add too. Price movement price movement alone is never a size trigger in either direction. Mistake number two: equal weighting everything. Um, what it looks like: um, allocating the same percentage of every position regardless of where each one sits in the conviction and asymmetry grid. 5% for every turnaround position, 5% for every swing trading position, clean, consistent across the entire portfolio. This feels disciplined. It is not. It is intellectual laziness dressed as a symmetric process, dressed as a systematic process. Equal weighting treats a high conviction, highly asymmetric position identically as a developing, uncertain one. It assigns the same capital to a thesis where all seven checklist questions pass cleanly as to one where two gatekeepers are amber. It makes no distinction between a position with 3 to 1 asymmetry and the one where the upside and downside are roughly comparable. The entire process of the analytical framework, the 7 question checklist, the conviction assessment, the asymmetry calculation, is to produce differentiated conclusions about different positions. Equal weighting ignores every one of those differentiated conclusions at the moment it matters the most, where capital is being allocated. If the analytical work produces no differentiation and allocation, it is producing no practical value at all. um Mistake number three: averaging down without re-underwriting. Yeah, what it looks like: adding to a losing position because the price has fallen, without first asking whether the conviction and asymmetry have genuinely improved, remained consistent, or deteriorated. This is the most. This is the most dangerous of all three mistakes. The most expensive because it contains a kernel of legitimate logic. Legitimate logic. A lower price on the same business does improve asymmetry mechanically. If the thesis is intact and the price has fallen, and the upside has increased and the downside have decreased, adding at a lower price on a confirmed thesis with the improved asymmetry is not averaging down in the projective sense. It is a staged position building work as intended. The mistake is assumption that the thesis is still intact without verifying it. Running the full monitoring framework in is the execution evidence still green? Are the thesis break conditions still remote? Has any of the MDNA or CONCOL changed conviction assessment? Before adding to a position, not after, before. A lower price does not confirm the thesis. A lower price on a confirmed thesis improves asymmetry. Those are different things, and the discipline of a re-underwriting before averaging down is a filter that converts dangerous a dangerous impulse into a sound allocation decision. Three mistakes, all three feel reasonable decisions in the moment. All three produce systematically worse outcomes than the framework applied correctly. The common thread, all three involve using a shortcut in place of the two variables. That actually that actually determine appropriate sizing. Recent past performance instead of assessment conviction assessment, equal weightage instead of differentiated analysis, price movement instead of thesis re-underwriting. The framework has no shortcuts. That is not a limitation. That is the point. Let me leave you with the single most important thing about position sizing. Sizing is not a consequence of stock picking, it is a parallel discipline that operates simultaneously with its own variable, with its own framework, with it and its own accountability structure. The investor who picks the right stocks and the wrong size will underperform the investor who picks moderately good stocks and good size over a long enough period, not because the stocks don't matter, but because the position size and determines how much each correct decision actually reaches the portfolio outcome. Like for example, a few years back, I picked some stocks that I picked some high conviction stocks that were approximately 3% of my portfolio size, and the other moderate conviction stocks were around 4% of my portfolio size. And those high conviction stocks went on and became three or four baggers in 2023. Yeah, in 2023, 2024. So that was a good return. But those moderate conviction stocks, they made money, but they didn't make enough money and they didn't reach my target, so I held on to them. And right now they're still in my portfolio and they're at a loss. So like, you really have to, but the thesis didn't change, so I'm not exiting them because the thesis is proven and I'm just adding more positions, not because not because I held it for so long, but because now we know that the thesis is proven and it became a high conviction bit now. Yeah, so that's what I'm saying. You should add more to your high conviction bet than your moderate conviction bets. Um, you can be right. You can be right about the business and barely benefit from it. And you can be wrong about the business and survive it cleanly. The difference between those two outcomes is almost entirely sizing. The framework 2 to 6% range, conviction and asymmetry as the two determining variables, extraordinary conviction override situations where both variables are confirmed at the highest level simultaneously, is not complicated, it's precise. Precision is what makes it useful under pressure. When a position falls, and the temptation to add without re-underwriting is strong, the framework has a specific answer. When the position is rising and the temptation to oversize is based on performance, recent performance is the strongest, the framework has a specific answer to that too. When a new opportunity appears and the story is compelling enough to skip analytical work, the framework has a specific answer for that also. Although that doesn't happen very much because now everything is everything is documented and all of that, so that doesn't happen a lot. It actually doesn't even happen to me right now. It's more of a beginner mistake to not analyze a stock before buying. This the answers are always same. Assess conviction through the framework, calculate asymmetry through the valuation, check the quadrants, check the quadrant position it sits in, size accordingly. Here's a practical thing I want you to take from this video. Before your next position entry, write down two numbers: your conviction level on a scale of 1 to 10, with a specific sentence explaining what analytical work produced that number as your asymmetry ratio. The upside in the central scenario divided by the downside in the thesis break scenario. If you cannot write both numbers down with a specific supporting evidence, you do not yet have a um, you do not yet have a practical enough analytical clarity to size the positions correctly and to act. The act of forcing those two numbers into writing is itself a discipline check. If those two numbers are vague, the analysis is incomplete. If the numbers are specific, the framework will tell you where the range belongs. The position range belongs. Two variables, one range, no shortcuts. Judge the process, the capital will follow. Thank you. Have a good day.